JPMorgan's chief U.S. economist Mike Feroli is back. Mike, it's great to check in with you. Good morning.
Good to see you.
You had a great chart last week looking at expectations for Q3 and really how Atlanta Fed has pulled away, and nobody can sort of understand what they're seeing. But what do you think explains their tracker?
So it's very early in the quarter, right? So we don't have much data yet for the third quarter. We did get a good retail sales report last week, so that does make it look like consumption is going to have a pretty good quarter here. And inventories are very lean, so that's probably going to, the restocking that's likely to occur there is also going to contribute to growth. But I wouldn't put too much weight on the estimates as they shake out this early in the quarter. But in a couple more weeks, I think we'll have a better sense. But either way, it does seem like it's off to a pretty good start.
Yeah, you did say maybe real consumer spend up maybe 3 to 4 this quarter?
Yeah, I think that's possible. Certainly after last week's number, it looks like July is certainly going to be a pretty good real consumption month. And every reason to believe, given what we're seeing and things like jobless claims, that the labor market is holding in. And so no reason to expect a big retrenchment in either August or September.
So does that mean that Powell needs to lean hawkish on Friday?
Well, look, I don't think Powell is going to try and send too strong a message here. I think the message that was reiterated in last week's minutes is that they're going to be data dependent. And they've already laid out what kind of data they're looking at. And we still don't have the August payrolls or CPI report, and that's going to inform their decision in September. So I don't think Powell is going to want to, front run the committee without having that data in hand. And while, as you mentioned, growth is coming in better, inflation has been coming in softer. So it doesn't necessarily, the combination of the two doesn't necessarily mean that the Fed has to do more here.
1 + 1 may not necessarily mean rate hikes. Speaking of rates, what do you make of the current dislocation that we're seeing in rates? What do you think the key driver here is? Is it duration supply? Is it growth outlook? Something else?
So we think a large part of it is the growth outlook and the improvement over the growth outlook over the past few weeks. So it's not, in our opinion, all that much of a surprise that we're seeing rates go back up to the highs of the cycle.
German PPI, Mike, goes negative first time since 2020. We spent a big part of the morning talking about China, and I know you've done some work about how much the spillover exists there in terms of feeding global deflation or disinflation. How do you think about that?
So right now, we're not too worried about the impact of the China growth slowdown on economic developments in the U.S. They're just not a big enough export market for the U.S. On the other hand, we actually think the deflationary impulse from the Chinese slowdown could add to the narrative of a soft landing here, and that would be yet another force contributing to softer goods inflation, which has been, one of the big drivers of the disinflation we've seen over the past few months. So, if anything, looking just at the U.S., there may be a bit of a silver lining out of the Chinese slowdown.
Oh, interesting. Just kind of going back to your take, I know you've kind of moderated your projection for, some kind of landing here. There's been some work about just the inverted yield curve, and, we're now about 11 months past the point where the 3s and 10s inverted, and whether that means a recession could come, in the next month or two. Do you pay any attention to that? Is that the precursor that it once was, or are there other forces you think at play that are dictating kind of the direction of that curve steepening?
Yeah, so no, we do look at that, and it would be kind of foolish to disregard a statistic like that has a pretty good track record. And it is one of the reasons, even though we are a little more optimistic on the outlook here, we still think recession risks in 2024 are definitely elevated. So I wouldn't, toss out that indicator or the things that we're seeing in the loan officer survey. I think there's a lot of things out there that suggest that the growth outlook in 24 could be, still pretty challenging. That said, I think there is at least some empirical work that suggests the slope of the curve isn't as strong a leading indicator as it has been in decades past. But even that being said, it's still not something that I would want to toss out.